Nothing.
No, I think the central case is that they actually do move interest rates higher. I think we've got a lot of market turmoil, a lot of volatility, and I think that people are getting very focused on the short term. The underlying fundamentals of the US economy are still strong. So yes, growth is going to slow next year. We think to around 2.5%, but it's been nearly 3% this year. So you've got to look at it in the context of still a lot of momentum in the economy, and most importantly, a very tight labour market.
You say that, and there seems to be still a lot of momentum in the economy. It's still growing north of 2.5%. Fine, it's not growing at 4%, but it's still growing. Why are people getting so nervous in your view? Why is there so much volatility? What is happening?
We are at the end of the cycle. I think they're looking at the fall in the stock market and be under no illusion that's going to make a difference, right? So the Fed will look at what that does, not so much from the stock market level itself, but rather for the tightening of financial conditions that we've seen. And what has been remarkable about this cycle is that for the first 2 years of tightening, financial conditions eased. It's really only in the last 6 months that we've seen a tightening of financial conditions. So again, we still have easier financial conditions today than at the start of this tightening cycle.
Now, if I look across the U.S. economy, one of the weak points has been the housing market, and a number of indicators suggest that there is some softening there. Just yesterday, the National Home Builders Association index dropped to its lowest reading since May 2015. So how concerned should we be about that, given a house is every American's largest asset?
Yeah, I don't think we should be overly concerned. Again, remember what the Fed has to do. It has to tighten policy. We need tighter financial conditions. A reflection of that is some softening in activity. We've been growing way above trend, taking out spare capacity. We've seen inflation pressures rise. We've seen wage rates rise. So the Fed is just doing their job, and that is to slow the economy down to a more trend-like growth pace. That's what we think they're in the process. Now, admittedly, we're in the later stages of that process, but that's what they're doing. They want to see the slowdown in activity.
So just talking about where you want to put your money then in 2019, we get it. Okay, the economy seems to be in a good shape. And you've written in your report that you prefer equities to credit, credit to rates, and EM to DM. I want to go back and just ask you about the equities to credit and credit over rates phenomenon, because it's interesting you say that, especially given it's coming at a time where credit really seems to be falling out of bed, specifically in the high yield space. People are getting quite nervous about some of the default probability going up, given that we're entering into late cycles. So I just wonder why you're placing credit so high on the spectrum here.
Well, again, equities above credit, right? Credit above rates. And partly the rate story is because we think the Fed still has more to do. So we don't expect maybe not even positive returns out of bonds, but very little out of government bonds. So I think if you think about it in that context, the credit cycle is certainly in the later stages, but you're now getting paid significantly more than you were 6 months ago. So that spread widening, of course, compensates you for that additional risk. Importantly, it's whether we have a recession on the horizon, right? So those default rates will pick up when we see a recession on the horizon. We certainly don't see that in 2019, maybe in the later stages of 2020. So we'd still say, whilst the cycle is long, it hasn't been as strong as previous cycles. We still see that cycle being extended into 2020.
Now, just to pick up on your view on credit, I understand you are structurally cautious on credit, but tactfully constructive in your terms. So what metrics are you most closely watching that would make you turn tactically bearish on credit? And when we do start to see default rates pick up, which sectors are you watching most closely?
Well, yeah, we obviously watch all of the sectors. You look at leverage levels, you look at the amount of debt that these companies are piling on, and that has increased, but we've kind of seen that stabilize. If you look in the high yield sector, in fact, there's been some evidence of deleveraging over the course of the last few months. So again, some signs of improvement in the underlying fundamentals. But as I said, we're tactically long, not structurally. We're in the later stages of the cycle. There is no doubt about that. Look at the sectors, of course, energy, not surprising. It makes up about 15% of the high yield market. Given the fall in the oil price, we've seen a lot of pressure there. The question is, do oil prices continue to decline, or is the strength of growth enough to put a floor under oil prices and see some improvement?
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.